Yeah, so good evening, friends. Rashmi, we are starting.
Yes, sir. Please start.
Yeah. So good evening, friends. Today we are at a webinar. I'm part of NISM as an adjunct faculty, and to tell you more about NISM is basically the National Institute of Securities Markets. It is an autonomous financial institution established by SEBI, which is Securities Exchange Board of India. It offers under its umbrella a broad range of education and research activities, primary activity being securities market education and research. It enhances the skills and the knowledge set of the participants of the market, and NISM also conducts certification exams and provides learning and training programs to ensure regulatory compliance and professional development in the area of securities market. To tell you about myself, I'm CA Madhav Mehta. I am associated with NISM as an adjunct faculty since last year. Before that, I used to be a visiting faculty to some extent. I primarily am a practicing chartered accountant, and my practice area involves the range of valuations and private market transactions, essentially on the corporate finance side. I am a 2002 November pass out, basically having almost 23, 24 years of practice. And before being in practice, I was part of Aditya Birla Finance in a role as a chief manager. That was in 2017. Prior to that, I was with Karvi Investment Banking and American Orient Capital Packet as part of their investment banking teams. So my work experience on the corporate side is about 15 odd years, and on my own is about 9 odd years. So that is a broad brief about myself. The format which we will follow today is that I have a short presentation about 8 or 10 slides, being the limited time which we have. If time permits, we may discuss some live examples for which I have some ready data available. And we will reserve the last 10 minutes for a Q&A session. You may post your questions in the Q&A section or in the chat section, and we will pick it up to be answered later. In case there is some continuous inputs to be given, you may put it in your, in case there is any continuous inputs required, you may put in your request in the chat box. Yeah. So I will now put on the presentation. Yes. The topic which we have today is how to read and analyze annual reports. And we will be looking at a cursive look on the same as to how to go about it, some broad principles rather than tactics. Yeah. So my presentation, I hope, is clearly visible to all the participants. Now, when we're talking about how to read and analyze financial statements, the first thing is we know what to read, correct? So it presumes when we are saying how to read, it presumes what to read. But generally, I find that there is a lack of understanding on what to read per se, and that has an effect on the way in which one tends to read, which is how to read. So the objectives of reading and reviewing and analyzing an annual report can be broadly categorized into 4 broad perspectives. First is an investor perspective. What is it an investor needs to know by reading the annual report and by analyzing the contents of the annual report? A banking perspective, what would the bankers of the company be interested in willing to know when reading and analyzing annual reports? A management perspective as to what would be the management and the employees or the stakeholders of the company be interested in knowing about the company from the annual reports, and others, which includes regulatory authorities, as to what they will be reading and what they would be interested. So the objectives of each of the groups of participants who will be wanting to read and understand the annual report would be different. From an investor's perspective, the primary question which an investor seeks to ask is, does an investment in this company, if at all is to be made, is likely to be fruitful? That is a principal question which an investor seeks to answer. And therefore, from the investor's perspective, the returns which the company is delivering vis-a-vis the rest of the market and the returns which the company is delivering vis-a-vis the risk which it is carrying on is what is looked at. If an investor is already invested in the company, then he looks at an annual report in order to track performance and to see if any corrective or any remedial or any positive action is required based on the delivered performance. From a banking perspective, a banker is primarily interested in the ability of the company to service its borrowings and to ensure that all the covenants are complied. If a lender is already on board as a lender, then he reads the annual report to check, will there be adequate resources available to service borrowings? Is the company following all the covenants which the banking system mandates in? How is the company performing so as for the bank to have a continued business association with the company? From a management perspective, the primary perspective is the business earning a return which is greater than the cost of capital. Yeah, every business deploys capital, and that capital is divided into two broad categories: debt and equity. Theoretically, the cost of equity would be much higher than the cost of debt for the primary reason that debt is a fixed obligation, whereas equity is a right to residual cash flows. The equity right is nothing but a right to the residual cash flows, means whatever remains after that, what remains is the right is available to the equity shareholders. And therefore, anything which is residuary will have a higher cost as compared to a fixed obligation. So the cost of capital for a company would be a combination of the cost of equity and the cost of debt. The cost of equity, evaluate the cost of equity, there are models available. One of them is the CAPM, which is a capital asset pricing model. But what it represents really is the investor expectations of return, is what really is represented by the cost of equity, rational investor expectations of return. So management will be interested in understanding whether the business is earning a return which is higher than the cost of capital, which means either it is adding value or it is not adding value. From the regulatory perspective, whether it is GST, income tax, or SEBI for that matter, they would read the annual reports to ensure that the compliances are in place. There is no evasion of taxes or evasion of compliances. And most importantly, a fairness check. Is the company operating in a just and fair manner on a public policy level? That is what also a regulator would like to check. So how to read an annual report takes us directly to the question as to what to read. And what to read comes from the objectives which each participant group wants to achieve by reading the annual reports. To summarize, an investor, whether an investment makes sense from a banking perspective, whether the company will be able to service obligations. From a management perspective, is the company earning a rate of return which is higher than the cost of capital, which means that it is add volume. If it is earning a rate of return which is lower than the cost of capital, then the company is not adding value. Yeah. Common sections of the annual report. Nowadays, the annual reports, most of the companies, listed company give their annual reports in a PDF form, or they send you a link in the PDF form on your mail, and you can download the annual report. Earlier, most of the annual reports used to be come in hardbound pages. Even today, you can request for an annual report in physical copy to the registrar, and the registrar would be bound to give you or supply to you as a shareholder a copy of the annual report in physical form. Most people don't know this, so I'm just reiterating that in case you are finding it difficult to read the annual report in a soft copy, you can always ask the registrar and the investor relations cell of the company to courier you a copy of the annual report. If you are a listed shareholder or if you are a shareholder of that company, it is your right to have a copy of your annual report. The annual report of the company broadly divided into around 6 or 7 sections. First is audit report, director's report, reports on corporate governance, internal controls, the financial statements, the P&L, profit or loss statement and its schedule. Normally, profit or loss statement is normally referred to as P&L statement, profit and loss. But as such, there will never be a profit and loss. It will always be a profit or loss statement. Yeah, balance sheet and its schedules, cash flow and its schedules. Notes to accounts, key notes to accounts being segmental reporting, related party transactions, audit report, financial statements, and notes to accounts shall be in most cases on a standalone basis and on a consolidation basis. What do we mean by a consolidated basis is if the company has any subsidiaries or any majority investments, then it is mandated that the company publish standalone results as well as consolidated results. The consolidated results being a summation of the standalone results plus the results of the subsidiary. Yeah. So the audit report and these financial statements would be for standalone and would be for consolidated. Beyond this, there is normally a section in the annual report which we refer to as management discussion or analysis, which is missing in this particular slide. The reason why it is missing is that it represents the management views and it is not part of the reporting. So management discussion and analysis is part of the annual report nowadays because it is a management representation or management view on the annual report or on the business per se, not necessarily an audited performance. Yeah. Analyzing, it has been the experience that analyzing financial and management decisions over past many years is more important than future projections, and often investors forecast way too high and analyze too little. That's the broad experience. Now, this is a complicated set of this. Let's say a typical annual report would be a 150-page document or a 200-page document, and a person may struggle as to what should be the chronology of reading the annual report, whether I should be reading the audit report first, in the chronology which is given, management discussion, audit report, director's report, then a report on the corporate governance standards, then come to the standalone financial statements, review the profit or loss statement, balance sheet, cash flow statement, refer the schedules, notes to account, come to the consolidated financials, refer the profit or loss, balance sheet, cash flow, then come to the notes to accounts to the consolidated figures. Or because no investor or no participants will have as much time to go through 200 or 300 pages of the annual report each time from point to point. So based on historical knowledge or based on the common operating knowledge in the industry, I have come up with a brief sequencing or the manner in which audit annual reports need to be read. Yeah, the sequencing is as follows. First, cash flow statement, followed by balance sheet, followed by profit or loss statement, followed by segmental results, followed by related party transactions, notes to accounts, the other notes to accounts, the audit report. Within the audit reports, the key audit points, the emphasis of matter and the management response, management discussion analysis at the way end, followed by the director's report and the corporate governance report. Whether we should read standalone first or whether we should read consolidated results first, that is the second question which comes to it. From an investor perspective, it is always relevant to read consolidated results first, followed by standalone. From a banker's perspective to a standalone entity, it always makes sense to read first the standalone as compared to the consolidated, because the primary exposure of the bank may be on the standalone results, and that will be the primary source of repayment. Yeah. Why this suggested order is there, that I will come to you. Before that, let us answer a few principal questions. First of all, whenever we read an annual report, there are certain principal questions which we seek to answer as investors, as management, and as other readers who are participants, whether as bankers or whether as regulators. First and foremost question, is the company making money or losing money? Means, are the operations of the company positive or negative? If positive, how much is the sustainable cash flow? Important word in this line is sustainable. How much is the sustainable cash flow, not the absolute cash flow? How do we get to sustainable cash flow? We'll see examples toward the end of the session. I have a couple of annual reports which I've kept handy. So we will look up some of those annual reports. Second question is, which we are seeking to answer, is what is the capital efficiency of operations? Are the operations of the company working capital efficient? Fixed asset turnover, fixed asset wise efficient? Means, is the capital which is deployed in the company, is it judicially used to achieve a maximum rate of return on the capital, or is it not judicially or efficiently used? Third question, does the company exhibit ability to pass on cost escalation to its customer, whether it is material cost or whether it is other cost? Is the company having adequate liquidity to sustain any shocks in the near term or the medium term? Most importantly, relevant from a banking perspective and from an investor's perspective, because the company needs to be able to have the resources or the wherewithal to sustain short-term temporary stocks, because there is no long-term without short-term. So the company, each company primarily has to sustain the short-term and the long-term for it to be long-term value additive. And third, last point, most importantly, is the company regulatorily compliant? When we do as an investor fundamental analysis, two ways in which investors operate, two primary ways. One is a fundamental analysis, one is a technical analysis. Technical analysis is more to do with chart reading. It is also referred to as charting to that matter. Principal assumptions of technical analysis being that all the information in the market is of the company is discounted in the market price. Price moves in trends and history repeats itself. So from a technical analysis perspective, analyzing annual reports may not be as relevant, but from a fundamental analysis perspective, it is the holy grail of fundamental analysis of annual report. Primarily because the primary assumption of fundamental analysis is performance drives wealth. Yeah. So when we say performance drives wealth, we have to analyze performance, and that analysis of performance, the primary document is the annual report. Now let us dwell into each of these principal questions more in depth to understand. First, is the company making money or losing money? If the company is making money or losing money means, are the operations of the company cash positive or cash negative? So where will we be able to first answer that question? Are the operations of the company cash positive or cash negative? In the cash flow, which is why the reason in the suggested list cash flow is at the first point. So we first read the cash flow suggested reading. How much is the sustainable cash flow? So cash flow is a combination of the cash profit and the working capital changes and the capital expenditure, beginning with cash from operation at the beginning, cash flow during the year, and cash flow at the end of the period. Now, to know how much is the sustainable profitability, the next thing is to look at the P&L and to understand the business of the company and look at the P&L in consonance. Remove any extraordinary items or non-operational items to arrive at what is the sustainable cash flow of the company. Yes. So that is therefore the second reason is balance sheet and profit or loss statement. Third, segmental results. Segmental result is mandated by an accounting standard which says that the company is to report segmental results based on the segments which has been reported, which has been devised for reporting. The segments can be geographical segment. For example, if there is a company which operates primarily as an export-oriented company and it has domestic sales and export sales, in which case the geographical segments like the US and the European market could be a geographical segment. The Southeast Asian market could be a geographical segment. The East Asian or the Middle East could be a geographical segment. So that is a geographical segment. So far as a business segment is concerned, let's take the example of ITC for that matter. ITC as a company used to operate in multiple businesses, tobacco being the primary business, FMCG, textiles, retailing. It has a Will's Lifestyle clothing brand. It is into paper and paper boards. So all the separate business verticals would be also independent business verticals or business segments. So that is part of segment reporting. Again, how much is the sustainable cash flow? Segmental reporting will be useful. If the mainstay business of the company ITC is a tobacco business and that continues to give year-on-year positive cash flows in a substantial manner and in a sustainable fashion, then we can say that cash flow from that business is a sustainable cash flow, let alone any marginal changes because of year-to-year fluctuations. Yes. So looking at the profit or loss statement vis-a-vis the segmental result and having an understanding of the overall business of the company would help in understanding and answering the question as to how much is the sustainable cash flow. Second, what is the capital efficiency of operations? Working capital efficiency refers to is what is the amount of working capital which a company requires for every 1 unit of incremental sales. What is the incremental working capital which a company requires for every 1 rupee of incremental sales? That is what we mean by working capital efficiency. So when we look up the cash flow statement, the cash flow statement in the indirect format starts with cash profit or EBITDA or for PAT for that matter, and then interest is added back. Then we have working capital changes. So if you compare the working capital changes or the delta working capital, which is reported in the cash flow statement, to the delta revenue, which can be inferred from the profit or loss statement, then we can know as to what is the incremental working capital efficiency of the operations of the company. Fixed asset turnover. How much is the investment in fixed assets the company is required to make to deliver its turnover? Again, the incremental fixed asset addition would be reported in the cash flow statement. And by looking at the incremental turnover which the company has achieved, some broad sense can be done, especially by doing a time series analysis as to what is the fixed asset intensity or the capital intensity of the operations of the company. Does the company exhibit an ability to pass on cost escalation to the customers? The third point, the ability of the company to pass on cost escalations to the customers is primarily predicated, or if I have to define it in one word, it is the ability of the company to maintain its margins. Yeah. So if a company has had a raw material cost escalation and it is able to pass on that raw material cost escalation to the customers, albeit with a lead or albeit with a lag in certain cases. For example, there may be a cost escalation in this quarter and the companies may be able to pass on the cost escalation to customers in the next quarter because there may be rate contracts which may need to be renegotiated. This is particularly true in case of B2B businesses. And in B2C businesses, this ability to pass on cost escalation to the customer is more pronounced as compared to B2B businesses. So if you compare the operating margins of the company across multiple years, especially on a time series basis, then that may be an indicative of the ability of the company to pass on cost escalations. Independently, on an individual item level also, material costs can be compared year on year. Employee costs can be compared year on year. Other direct costs can be compared year on year to check whether the company has been able to pass on costs to the customer or not. When we say the pricing power of the company, pricing power, a company has a high pricing power. What do we mean by that? We primarily mean that the company has an ability to pass on cost escalation to its customer and thereby maintaining pricing power. To give you a few examples, some companies which are listed and popularly known have exhibited continuous examples or continuous ability to pass on cost. To give you an example, Pidilite Industries, it is the owner of the brand Fevicol. That company is almost able to continuously pass on cost escalation to its customers. The cigarette industry led by ITC has been able to exhibit a continuous ability to pass on cost to the customer, including higher taxation. The liquor industry and the prominent players in that, the Diageo or Radico Khaitan, they have also exhibited continuous ability to pass on cost. Some industries where the company is an industry leader or the company is having a higher level of value addition, you will see this characteristic whereby the company is able to not only maintain margins but also improve margins as the sales improves. Yeah. Fourth point, is the company having adequate liquidity to sustain any shocks in the near term? This question seems to be a question of interest primarily to the bankers of the company, but that's not the case. It is also useful to an investor of the company because in the market there is a saying which says that there is no long term without short term, which means that we have to survive in the short term in order to see the long term. And what will help the company survive in the short term? An adequate flow of liquidity. Suppose COVID were to happen again, or there could be a one more lockdown of 20 days and business may be stuck. Does the company have liquidity to sustain its operations, to pay its basic salaries, to pay its basic overheads so that the company survives to live for another day? Yeah. Finally, is the company regulatorily compliant? What do we mean by regulatory compliance? In the audit report, as part of CARO, which is companies auditors report, audit reporting, there is a clause which says that is the company regularly in depositing its undisputed statutory dues? If the answer to that question is no, then it is a worrisome tendency because the company is not principally depositing its undistributed statutory dues in a timely manner. Whether the company has paid GST on all the turnover which it has reported, whether the company has paid the full amount of income tax in a fair and just manner at the time of filing its income tax return, the tax authorities will be relying on the annual report to check the credentials of the company. whether the company has any cases of unattended investor complaints. Normally in listed companies, there is now a mandatory reporting of a table of the number of investor complaints received during the quarter, received during the year, and the number which has been addressed, the numbers which are pending. So that is also a compliance which companies are reporting. So whether the company is complying from the investor perspective. So the annual reports gives these are the principal questions which any reader of the annual report seeks to answer. That is why I have listed the same. Now coming to the independent, first we have listed cash flow statement. Cash flow statement is something which comprises of three parts: cash from investing activities, cash from operating activities, and cash from financing activities. The order of reporting is first cash from operating activities, but when I said cash from investing activities first. I did not say cash from operating activities. I said cash from operating activities second to cash from investing activities. One of the reasons why I said so is because cash from investing activities primarily indicates the capex which the company has done, the investments which the company has made in the subsidiaries. How much is the money, fresh money, which has been deployed by the company as capital expenditure, comes from cash from investing activities. Then we can answer the question, this money has been raised in what manner? Has the operations been sufficient to take care of this capex, or did the company have to borrow or raise money by way of equity sources to fund this capex? That is the second question. So through investing activities, we answer these three questions. If the company has been able to manage its capex based on operating activities, then what is the cash profit? Yes, that is the next question. So I am opening up a particular annual report to take you through the cash flow statement. So first is cash from operating activities. This is an annual report of a listed company called Precision Camshafts. It is a dated annual report. It is a 2024 annual report, and therefore we are using it. It is publicly available for anybody or anyone to download. You can also download on their own laptops or your own desktops and review it while I share the screen. So first is, what I am suggesting is that this is a cash flow statement. Within the cash flow statement, you can start from cash from investing activities. The total investments which the company has made in investing activities is 94 crores. This is rupees in lakhs, so it is 94 crores or 9440 lakhs. Yes. How this has been funded? How much operations the company has, operation cash flow the company has thrown up? 130 crores. What is the cash flow from investing activity? Negative 12.5 crores or 1250 crores, 1250 lakhs. So what we can infer from here? The operating activities cash flows are sufficient to take care of the company's investing activities and the financing activities. So we have answered effectively, we have answered the first question, which is this question. Is the company making money or losing money? This is a question which you have answered through the cash flow. The answer is the company is primarily making money because it is cash positive. The next question which we seek to answer, how sustainable is the cash flow or the operating margins of the company? So in this, we find that the total profit on a consolidated level for the year is 40 crores or 4035 lakhs. In there, is there any other income? Is there any non-operating income? I am not seeing any exceptional income. There is an exceptional items here. I can see 18 crores. So exceptional items are generally one-time items and they are not part of sustainable operations. So while the company has reported a profit for the year of 40 crores or 4035 lakhs, out of that 1829 lakhs or 18.29 crores is exceptional items. So would it be fair to exclude these exceptional items to arrive at the sustainable cash flow? The answer is a positive yes. So the sustainable profitability of this company is 40 minus 18 based on last. In the prior year, there was no exceptional item, which means that between 2023 and 2024, the business has suffered some cost escalations which it has not been able to pass on, or there has been some events where the price increases have not been able to pass on to the customer, or the customers have renegotiated. Because last year the profit was 46 crores, this year the profit is 40 crores, but this 40 crores is after exceptional item of 18 crores. So now through this we have answered the next question, which is how sustainable is the cash flow of the company. Yes, working capital efficiency. Again, if you go back to this, we can look at the balance sheet. Working capital is nothing but current assets minus current liabilities. So total current assets are 662 crores or 66,266 lakhs, minus current liabilities is 266 crores. So roughly around 400 crores of working capital, or 400 crores of working capital, delivering a sales volume of around 1,031 crores, which means that every rupee of sales increase requires the company to deploy around 40 paise of working capital. That seems to be the case. What is the corresponding number in the previous year? Let us see what has happened in the previous year. In the cash flow statement, we can see working capital adjustments. The working capital adjustments total to 151 minus 109, which is around 40 crores. Yeah, 40 crores is a working capital adjustment. Out of that 40 crores of adjustment, this is a positive adjustment because the inventories have given a positive cash flow, means the inventory holding has come down. So again, referring the cash flow statement, the balance sheet and the P&L, the second principal question can be answered, which is what is the capital efficiency. Cost escalation we have already answered. Is there adequate liquidity to sustain any shocks in the near term? What is the cash balance which the company is carrying? 43 crores. What is the monthly fixed cost which the company is having in terms of salaries? From the profit or loss statement, we can infer what is the employee cost. So employee cost is 191 crores. The company is carrying a cash balance of around 40 crores, which means that it is carrying at any point of time roughly 4 to 5 months of salaries as cash, which means that the near-term liquidity seems to be okay. Even from a banker's perspective, if there is no term debt in this company as such, but if there is a term debt, then the repayment of term debt company will require to hold 3 to 4 months repayment of term debt as surplus cash in order to be comfortable. Is the company regulatory compliant? Again, the auditor reports answers that question in substance. The investor complaints and the investor complaints, how they have been addressed. The report on corporate governance and internal controls, and the overall reporting of the company in terms of the notes to accounts and the schedules ensures that whether the company has been regulatorily compliant. So we've addressed this. Profit or loss statement. When we look at the profit or loss statement, the first and foremost thing which we seek to answer is what's the waterfall? Means for every rupee of sales which the company makes, how much is the raw material cost? How much percentage is the employee cost? How much percentage is the other overheads? What is the EBITDA margin of the company? What is the interest cost vis-a-vis the sales? What is the depreciation which the company has to provide? What is the profit before tax? What is the taxation impact? And finally, what is the net profit after tax, followed by the percentage of profits which are distributed as dividend, and what is the retained earnings of the company. So this, every rupee of sales which flows to the company's profit or loss statement. Profit or loss statement is a period statement. It is not a point statement. We always say profit or loss statement for the period 31st March, for the period ended 31st March 2024. So it is for the 1 year, 1st April 2023 to 31st March 2024, or 1st April 2024 to 31st March 2025. So what is the waterfall? How the sales translates to net profit can be looked at and can be reviewed from the profit or loss statement. The ability to pass down cost we already touched upon. The operating leverage. Operating leverage is a corporate finance concept. What it means is that how quickly the company is able to break even and ride its fixed cost, which means that cost can be broadly broken up into fixed cost and variable cost. There are some semi-variable costs. Most fixed costs are actually semi-variable in nature, but broadly broken up into fixed cost and variable cost. Once the company meets its variable cost, how quickly then the company meets its variable cost. The higher the component of fixed cost and the higher the contribution margin or the margin after variable cost, the better the operating leverage of the company. So if you look at the P&L, the raw material cost is a variable cost. The direct expense is a variable cost. After that, the selling and administration overheads and the fixed cost and the employee cost to some extent, to almost large extent, are fixed cost. So the lower the percentage of variable cost vis-a-vis the sales and greater the break-even ability of the company at a lower sales, the better the operating leverage of the company. So that can be known from an analysis of the profit or loss statement. The impact of debt on overall operations of the company, in turn leading to financial leverage. What is the impact of debt? Means the interest cost as percentage of EBITDA as percentage of the turnover. So is the company earning sufficient to service the interest on its borrowings which it has made? Is there adequate? What is the coverage? If my interest cost is 100 rupees and my EBITDA, the earnings before interest and depreciation is, let's say, 400 rupees, that means my interest coverage ratio is 400 divided by 100, which is 4 times, which means that I have 4 times the ability to service the existing interest. Higher the interest coverage ratio, better it is. So the ability of the company to service interest or the impact which debt has on the overall operations, which in turn is also referred to as the financial leverage, this can be assessed from the P&L. The impact of taxation, the percentage profits paid out as dividend and the percentage profits retained as retained earnings to fund its future growth plans. This would also flow from the profit or loss statement. The balance sheet is a point statement. The profit or loss statement on the cash flow statement were a period statements, which means it will be cash flow for the period financial year 23-24, cash flow for the period financial year 24-25, profit or loss for the period 24-25, but balance sheet as on, which means that balance sheet is a statement of balances. It is a point statement. Balance sheet read with the financial cash flow statement and the profit or loss statements helps us figure out the financial leverage. How much is the incremental sales are funded by receivables. So if there is a sales increase from, let's say, 100 to 200, whereas the receivables have increased drastically and not in proportion to the increase in sales, which means that bulk of the sales have been funded by receivables. How much increase in stocking was required to deliver incremental sales? How much of the incremental sales are funded by creditors? Since the balance sheet reports the figures of creditors, receivables, and the stock figures, this analysis can be done only through the balance sheet by referring to those figures and calculating them as percentage to the turnover. The capital efficiency in terms of the fixed asset turnover, how much fixed assets are used to deliver a turnover, and the working capital again flows from the analysis of the balance sheet. The return ratios, what is the return on capital employed and what is the return on net worth, which are two principal ratios which are primarily important from a corporate finance perspective and from an investor perspective. If the return on capital employed is lower than the return cost of capital of the company, which is a combination of the cost of equity and the cost of debt based on the proportion in which the funding sources are used, whether equity or debt, then in that case, if the return on capital is higher, which means that the company is adding value to its stakeholders. If not, then the company is losing value. What is the return on net worth? The net worth means the return on equity. Return on net worth and return on equity are synonymous terms. They are used synonymously. The numerator in either of the ratios being the return number and the denominator being the capital employed or the net worth corresponding. When we have the denominator as the capital employed, the numerator would be the return available to equity shareholders and the return available to debt holders. What is the return available to debt holders? Interest. What is the return available to equity holders? profit after interest and depreciation. So the EBITDA or the EBIT number is used for calculating the return on capital employed, whereas for the return on net worth, the PAT is used or the profit after tax is used because that is what is available to the equity shareholders. Now, a very brief view among the participants, there may be a few non-accountants, and typically I find that most non-accountants have a tough time or they have a mental block to some extent to read annual reports saying that we are not qualified accountants. How do we go about reading this complex jaggery and how do you use? But even if you don't know accounts, all of us know basic mathematics. And if you know basic mathematics, I am giving you a scheme whereby you can understand an annual report or understand or read financial statements. We all know that our net worth or our capital is equal to our assets minus liability. There is only one equation we all need to know, either as a personal finance angle also. So even as a personal finance, we all know how to calculate our capital. Our own capital is our assets minus our liabilities. Yes. So if you remember this one principal equation, capital is equal to assets minus liabilities or outside liabilities. All the other things are subsidiary to it. For example, the profit or loss is income minus expenditure. We can further expand this income as income from operations, other operating income, minus expense includes raw material, overheads, employee cost, selling and administration overheads, EBITDA, interest, depreciation, tax, PAT. So if you can lay down the financial statements in the form of an equation, with primary equation being capital is equal to assets minus liabilities, and all the other equations being subsidiary equations, you will understand that life is much easier. So for non-accountants, knowing basic mathematics is good enough to understand basic financial statements or basic annual reports. Both sides of the balance sheet, the liability side and the asset side, the sources of the funds and the application of the funds always have to tally. So look at the sources of the funds and the sources and application as an equation. When you start looking at the balance sheet and the P&L as equations, you will suddenly realize that it is much more easier to understand and compute rather than be stuck in complex jargon. Yeah. Some commonly used terms of not understood in the balance sheet. I will just take a brief 5-10 minutes before we open the forum for question and answers. Goodwill. This is a word which occurs in quite a few annual reports. It occurs quite a few analyst reports. Where does goodwill come from? Can goodwill be bought? The answer to the question, goodwill is appearing in the balance sheet only and only because the company has done some acquisition, some consolidation, some merger, wherein the company has paid an amount to the outgoing person or for that consolidation or for that merger or for that acquisition, an amount which is higher than the fair value or the higher than the net assets of the which has it is acquired. For example, if the net assets of the company which is being acquired is 100, whereas the company which is acquiring the company pays 120 for that, then the excess 20 over and above net assets is the goodwill which it has paid. And that is why a goodwill is a non-cash item because it represents excess payment on acquisition, and therefore accounting standards in India mandate goodwill to be written off or tested yearly for impairment or write-off, because that asset may or may not exist because the company has overpaid. So it has to be tested for impairment at the end of each reporting period. Lease obligation can broadly be categorized into finance lease and operating lease. Operating lease is nothing but what we understand plain vanilla as a rental model. Then what is the difference between an operating and a finance lease? A finance lease is something which means that it is more in the nature of ownership. Any long-term leases, for example, an industry is set up where MIDC has given land, or the Maharashtra Industrial Development Corporation, or the Gujarat Industrial Development Corporation, or the respective Industrial Development Corporation of the particular state has given land on a 99-year lease. That is an effective ownership, and that to that extent, that is a finance lease. Deferred tax assets, deferred tax liabilities. The difference between the profits computed for taxation purposes and the profits computed or reported in the books of accounts or in the audited statements, that gives rise to deferred tax assets and deferred tax liabilities. The differences can be on two counts: permanent differences and temporary differences. Permanent differences or temporary or timing differences is what leads to deferred tax assets or liabilities. Permanent differences do not lead to deferred tax assets or liabilities. Related party transaction, there is a separate it is mandated that every company has to publish related party transaction and pass on notes to accounts. Related party transaction can be looked at from a perspective as to what is the need and the fairness and the pricing at which those transactions have been done. Whether arm's length have been maintained or not, or whether there is any sort of nepotism or whether there is any sort of leakages in the company. Forex gains or losses can be realized or unrealized. If it is unrealized, it goes directly to the balance sheet. If it is realized, it goes through the P&L. Depreciation, is it a non-cash expense? The answer is it is a non-cash expense, but should it be considered always as not necessary and should be excluded for analysis? The answer is no. Depreciation represents the reduction or the diminution in the value of the assets of the company because of use, and therefore depreciation to that extent should always be considered as part of analysis. Higher profits is equal to higher business cash flows. The answer is not necessarily a yes. Profits may be higher, but that profits may be sucked in by working capital because the company may have reported higher profits by pushing sales, and those sales may be supported by higher receivables and higher stocking. In which case, although the profits are higher, the cash flows may not be higher. So therefore, higher profit does not always represent higher business cash flows. Incremental working capital, we've already considered that in the earlier discussion. Sales growth, when you look at sales growth, always try and understand the segregation of the sales growth by way of volume growth and pricing growth or value growth. They lead to important indicators. Yeah, now I will open up the forum for any questions and answers. We have a brief 10 minutes, 10 to 12 minutes. If we have any questions or I can do some exercises. Do we have any questions, team? Yeah. I have a few questions. I have about 8 or 9 questions. I will briefly translate. How will this help us? What can we use? I need all the information. Yes, Gurpreet ji, how will it help you? If you are an investor in the markets and a stakeholder in a company, it will help you track performance of those companies. It will also help you identify opportunities for investments. If you are a debt holder in that company, if you are holding public deposits, for example, if you have invested in banks, whether by your fixed deposits or by your bonds, you can check the health of the company banking of the bank in which you have held the deposits through the annual reports. So annual report is basically a report card for the financial year, if I have to use one word. So whatever a report card of your kids does to upbringing or analyzing your kids' performance, the same report card for the company in which you have invested or you are purporting to invest does for you in terms of the annual report. The second question is, can I get the PPT? I will have to speak to the organizers. Rashmit, please, I am happy to share the PPT. There is not a problem. What are the 3 major subject matter to read while analyzing the company through the annual report? The 3 major subject matters to read while analyzing the company through the annual report is to go through the 3 things: cash flow, balance sheet, and the profit or loss, and the corresponding schedules, if at all you need to refer to it. The audit report, specifically the emphasis of matter means, are there any qualifications in the audit report? That is what needs to be looked at. You need not read the entire annual report from a layman's perspective. But if the 3 things which has to be written, then it is P&L, balance sheet, and cash flow. What are the functions of SEBI? SEBI has a full-fledged website. You can go to the website of SEBI. SEBI refers to the Securities Exchange Board of India. So it is a regulator. It is also called as the capital market regulator. Any money, raising money or dealing in public money, for that matter, other than banks, for which the regulator is the RBI or the Reserve Bank of India, any corporates which are raising money or looking into tapping into public monies where the public interest is involved, SEBI is a regulator or the guardian agency for that. And as part of NISM, this NISM is a SEBI controlled institute. It is run by the SEBI, and NISM seeks to enable professional development research in the area of capital markets. So that is broadly the function of SEBI. Is there any awareness courses provided by SEBI? Yes, there are a number of awareness courses which are provided. They are handled by NISM. There are investor awareness programs also by NISM. Most of the information would be regularly updated on the NISM website and the SEBI website. For that matter, you can get in touch with our representatives or the contact details provided in the website. Is SEBI a statutory body? Yes, SEBI is a statutory body. It represents the government, and it is a regulatory agency. It is a statutory body. There is a separate act by which Parliament Act under which SEBI has been incorporated, and SEBI represents that. Please explain sustainable cash flow. What do I mean by sustainable cash flow? For example, let's say we just read through the annual report of a company called Precision Camshafts, and this company, Precision Camshafts, let me take you through the annual report. Yeah, so you have this consolidated profit or loss statement. Last year, the revenue was 1080 crore or 108014 lakhs. The corresponding profit for the year was 46.28 crores or 4628 lakhs. In financial year 23-24, the turnover has reduced from 1080 crore to 1031 crores or 103113 lakhs. And the corresponding profit for the year is 40.35 crores. This profit compares to some extent with the profit of the previous year. But when you look fine-tuned, you will realize that there is an exceptional item here, which is 18.29 crores. Exceptional item means an item which is not regular in nature. It is a one-time item in nature. If there is an exceptional item, can it be said that this exceptional item will repeat on year? If it is repeating year on year, then it is no longer an exceptional item, correct? So what I mean is that first and foremost, on a hard level, as a rule of thumb, when you calculate sustainable profits, reduce any exceptional items or non-operating income. Second, if there is a bumper year which the company has had, for example, during COVID times, a lot of pharma players had bumper year and a bumper profitability because during COVID periods, there was fear psychosis and a lot of drugs like the Dolos and the Crosins and the paracetamols were bought heavily by people. Even nutraceuticals or for that matter, vitamin tablets were heavily bought by people. Because of that, their sales saw an abnormal shift or an abnormal rise. Yeah, that abnormal rise or abnormal shift yielded an income which would otherwise not have been there in a steady state basis. So when COVID subsided, that particular abrupt increase in sales also subsided. So what I mean by sustainable is that these one-time adjustments or these opportunistic profits or these opportunistic losses or exceptional losses should be excluded from the reported profitability or the reported losses to arrive at the sustainable cash flow. That is what I meant. Yeah. I hope I have answered your question. If there is anything, I can come back to you again. What macroeconomic factors are expected to impact performance? That will need a whole session in itself. In fact, multiple sessions, right from the GDP to the balance of payments to the money supply would impact the performance of the company in a small way. Yes, it would impact the performance of the company in a small way, but obviously each company's impact may not be the same. For example, a company which is operating in the tobacco segment, if there is a drastic increase in the taxation in tobacco segment, and the company may not be able to pass on that impact, then there is a big macroeconomic impact. But if there is a modest increase in taxation and the company has continuously exhibited an ability to pass on cost, then that may not be a very important factor. But in terms of tracking macroeconomic factors, I think the RBI website gives a lot of data on macroeconomic factors. Even the Niti Aayog gives a lot of information. Recently, the economic survey has been published. It's a 500-page document. If you can go through that economic survey, it is a fantastic document and it gives the entire understanding on the economy per se for a tracking on the macroeconomic level. How fixed asset turnover? We will be using operating assets or total assets. For fixed assets turnover, you will be using the fixed block of the company, which means the Gross block minus depreciation, the net block. You will be using the fixed gross block of the company to calculate the fixed asset turnover. How to calculate enterprise value? Enterprise value is market capitalization, means the price per share multiplied by the total number of outstanding shares, that is the market capitalization, plus the net debt. Net debt is outstanding debt as on the date on which it is being calculated, minus the cash which the company is holding. So market cap plus net debt is what is enterprise value. Can you show all slides? I will ask them to circulate the slides. I can show, I think I have reviewed all the slides. I have not missed any slides. Are there any specific signs or pattern in the financial statement that might indicate underlying financial issues? A dip in sales or continuous increases in sales with a continuous increase in the working capital days, or the working capital increasing more than proportion as compared to the sales growth might indicate of financial issues. Normally, in the markets, we normally say that there is a rule of thumb, or we say to that extent impossible trinity in that manner. Not always impossible, but most of the time impossible. The three factors are rising sales, reducing working capital, and rising margins. The answer is choose any two. Means rising sales, if there's a sales is increasing, margin is also increasing, then generally working capital will generally tend to expand. If there is a rise in turnover and a reduction in working capital, generally margins tend to contract. So you can review the combinations of these three in rising sales, margins, and working capital intensity, days reducing or expanding. That will broadly help you understand the specific signs or patterns. Operating margin, to explain you the operating margin slowly, by operating margin means the primary margin after fixed cost and after variable cost from the operations. So if 100 rupees is my sale, 50 rupees is my variable cost, 20 rupees is my fixed cost, then 30, which is 100 minus 50 minus 20, represents my operating profit. 30 is the operating profit. Operating profit divided by the sales, which is the revenue. 30 divided by 100, that is 30% is the operating margin. What are the basic things that small investors consider in annual reports for making decisions? Most of the times, small investors don't really go through the annual reports. They rely more on the financial snapshots which are available on the stock exchange websites or on their broker websites. It will be useful for them to review annual reports, especially the notes to the accounts in terms of related party segmental reports, cash flows. In the stock exchange website, cash flow statement is not reported. Only the balance sheet and the profit or loss summarized numbers are reported. So annual report, a small investor should go through the annual report, especially the cash flow statement read with the P&L and the balance sheet. Where will I get in-depth analysis and study of annual reports? There are a number of videos available. In fact, NISM does come up with frequent sessions. You can enroll to one of those sessions. That will be useful. How to identify red flags in the balance sheet? Normally, red flags will come either as part of the extraordinary or continued qualifications in the audit report, some remarks in the corporate governance report or the secretarial report, or continued non-compliance or regulatory non-compliance. These are typical red flags which come up as part of stress. And the ability of the company to have not been able to meet its immediate debt payments. How can a research scholar should concentrate in this analysis? I think you need to do extensive, a proper course in financial analysis and modeling, and that is the way to go. How to make an analysis report for any company? There are a number of freely sourced analysis are available. You can read up on many of them, and you may be able to come up with them. Is the market crash already known by the big investors and FI? Answer to that question, it is a personal opinion. Nobody knows what happens next. Yes, it is only the odds. So whatever we are saying, whatever we are doing, it is always a surmise and a conjecture. Somebody may be better informed, more experienced, but beyond the better informed and the more experienced, there is no other way that anybody else will know exactly what will happen. So if you close your hand too close to the eye, you will not see. If you hold your hand too far away, you will not see. So kal kya hoga? What will happen tomorrow? Nobody knows. What will happen in the secular future? That also nobody knows. That is why in fundamental analysis, we say there is a predictable period, a 3 to 5 year period, or one business cycle is what we call. Yeah. For a long-term investor perspective, think in annual report is Y1 can be drastically down or increase in Y4. How to keep track of these fluctuations? You will have to cultivate the art of reading. There is no substitute to reading annual reports and analyzing them. Okay, I take your feedback. I had a lot of ground to cover, so I had to go fast. Which source is the best for analyzing overview the fundamentals? And the second question is to go with technical analysis of fundamental. Technical analysis or fundamental analysis, there is nothing like a or, they are complementary in nature. It is not fundamental to the exclusion of technical or technical to the exclusion of fundamentals. Both have different set of assumptions, both work for different time frames and for different objectives. Will attending these webinars be of any use to someone who has just appeared 12th grade? I have trouble understanding some terms, but I am noting them down. It is a good starting place to be, but it will not suffice by itself. You will need to do your own work. Difference between fundamental analysis. Fundamental analysis tracks performance of the company. Primary assumption of fundamental is performance drives wealth, which means that if the company has performed well, eventually the stock price will also perform well. Technical analysis presumes that all the information about the company which is available to the market is already discounted in the stock price, and therefore there is no point in analyzing the individual company level performance, but more it is to do with market psychology. So technical analysis is analysis of using market psychology rather than performance of the company. Are there any shortcut methods to quickly analyze the reports? I will just take a couple of more minutes before I close the session because we have a hard stop at Rashmi. I hope that is fine. Are there any shortcut methods to quickly analyze the reports by a non-commerce students? Try to see the balance sheet as a set of equations. I have already explained it in my presentation. Try to read up more commentary on the annual reports or the con call transcripts to better understand. It will help you. How to analyze specific sections of annual or provide examples of it. I have answered that question earlier. What we need to note in management discussion analysis. Most important to read is management discussion analysis is to see whether what the management is having a view and whether what strategy it is having, is it following the strategy and following that view in the next years or not. So is the management walking the talk or is it talking differently and doing differently? That is what needs to be viewed. How is it helpful in taking better gathering investment options? It is more to do with performance management rather than gathering investment options. So I think your question is slightly misplaced. What is finance income? How can it be negative? Finance income is not negative. It may be that the company has surplus cash which it has invested, and therefore finance income would be negative, means that the company has earned by deploying surplus cash. When was certificate published? I didn't understand your question. What about macro income? How can we correlate? I have answered this question. What is cost escalation? Cost escalation is that, for example, if you need a raw material to produce a particular finished goods, which is your finished product, and the raw material cost price increases, whether you will be able to pass on the raw material cost price to as part of the finished goods, yes or no? Can you explain the term cost of goods sold? Cost of goods sold is all that is required to make the goods ready to be sold to the market, which includes raw material cost, employee cost, other overheads, selling and distribution overheads, including marketing cost, all the costs which are required to produce a particular product, to bring it, to make it ready for sale, is part of cost of goods sold. What are the company key growth drivers as per MDA? You can review a few NDA, how to read annual using Chat GPT. I will not be answering this question because you can ask Chat GPT, you can test it for yourself. Would it be having possible for a layman to know that there is some fraud that is happening in Gensol before SEBI took action? Yes, it would. It might be. There may be some flagging or some indicators. In fact, if you read SEBI's report, it may itself show up pointers. How to find whether the company is overvalued or undervalued based on price? That is a separate question. It is not the subject matter of this course. I will not be able to dwell on this at this point of time. How consistent is the cash flow compared to the net income? Yes, you can review time series analysis of cash flow to know as to what is the profit reports of the company and what is the corresponding cash flow of the company. Is the profit reporting and the cash flow moving in line, or are they crisscrossing? Where can one study things related to finance? A lot of sources available. Please explain, can consolidated standalone profit and loss report for a retail investor? The ideal thing to do is to start with consolidated for a retail investor. Is it suggestible to use the screener in website for the company's reports? Yes, you can use it. What courses should a non-finance student do to excel in a career in finance? In terms of self-study, start reading more annual reports, start following more companies, start looking up stock exchange website, and then do these courses which NISM has to offer, especially for non-finance people. Can you please explain a little bit of financial leverage? Financial leverage means when a company has borrowed money, the obligations are fixed in nature, which means the interest obligations are fixed in nature and the principal obligations are fixed in nature. So if a company by deploying that money is able to make a return which is much higher than its obligations, then that is a financial leverage it is operating, which means that even if the company makes higher earning by using that money, the amount of payment which it has to make to the fixed holders or the debt holders is the same. And therefore, the surplus which it makes over and above that, that is part of the financial leverage. Similarly, if the company makes a lower earning as compared to what it should make by deploying the capital of the debt fund holders, then the obligation is fixed. So it has to pay out of its pocket, which means that the financial leverage is again operating on the reverse side or the negative side. While attending these seminars of avenues to summarize as part, I have answered the question and indicated beyond under that is not subject. It is a part of fundamental analysis. What is the bank cost to income ratio? Bank cost to income ratio is a total finance cost excluded for non-bank cost divided by the profits available for servicing that, which is the EBITDA. How does ratios play a role in ratio analysis and should there be considered for sole analysis, in which ratio analysis is a very important tool, but it is not the holy grail. People do also calculate minority shareholders and non-controlling shareholding to find enterprise value, since you said only market cap debt. When I say market cap, I refer to a listed company. So if you're having a listed company, then the market cap, what I've said is correct. The market price already removes the minority interest while listing or while quoting the price. So there is no requirement to remove minority interest while calculating enterprise value when the company is a listed share and your point of reference is market cap. So market price refers the price which is quoted on the stock exchange multiplied by the number of shares outstanding. Will the imposing high tariff in countries like that is not part of this session? We will not be able to answer this question because it is too long a session, shorter session. Which part of the report helps in comparing with other companies? No part of the report helps in comparing with other companies. The ratio analysis and the snapshot balance sheet and P&L can be compared with the ratio analysis and the snapshot balance sheet P&L of other companies. What is inventories of finished goods? Yes, finished goods are goods which are ready and ready for sale. Work in process is something which is yet not ready to sell, but it is in process, likely to be converted into finished stock. Abhishek Chauhan, what is your question? I have not been able to follow. Can you explain that? I have explained the term cost of goods sold, which part of the exports helps in comparing with other. I have answered the question. The answer to that question, Ankur, is that it is not safe to invest in a company which has not been able to repay its debt. How the indicators are helpful in choosing better technical analysis? The annual report indicators are not helpful in choosing whether to use technical analysis or not per se. How does ratios play? I have answered this question. How does ratios play a role in analysis and should they be considered as sole things? Ratios play an important role in analysis, especially on a comparative analysis. Is it the sole role of ratio analysis? Answer is no. Absolute figures also matter. Ratios indicate important red flags or important mismatches which should be further investigated to find out what is the true nature and what is the true nature of the red flag. It is not an end in itself, but it is an important starting point. So ratio analysis is a very good starting point. I hope I have answered your question, Abhishek. Which ratio should be more focused? You can refer the DuPont model, which we call, which is a combination of the profitability ratio, efficiency ratio, and the return ratio. That is a good starting point. By analyzing the annual report, you may have a sense of what is a sustainable cash flow, and to that extent, you may be able to help analyzing. Finance income is negative because surplus cash has been deployed to earn finance income instead of not earn finance income. Income finance, you can refer to the NISM website. Various courses are listed therein, Joseph. It will be a useful guide. You can also get into touch with the admin guys and the faculty there. I have answered Abhishek, I have answered your question. Which part of the report helps in comparing with other companies? I have answered. Deferred tax I've tried to touch upon briefly. We are slightly short on time, so I think we will have to call it a day. Outstanding shares is the total number of our shares outstanding. What's the most important thing every retailer should watch on the annual report? Three broad things. Whether the company has been able to service its debt obligations or not, that is something which retail investor should definitely check. Are there any continued negative qualifications from the auditor year on year which are continuing, against which management is not doing anything? And related party transactions, if they are too high in number and not at arm's length, then that's an issue which you should track. Which annual report will be beneficial from a fundamental analysis perspective. Yeah, I am through, Rashmit. I think we can end the session. I think I have replied to most of the questions. I have overshot my time by around 10 minutes. To that extent, I'm sorry for that. Thank you very much, friends. Good day.